What do you make of just some of the action that we're seeing in the markets and how it's impacting the bond market itself? The bond market, something the president seems to be reacting to. And these bond traders, they don't seem to like all this tariff uncertainty.
Yeah, so the tariff uncertainty is driving a lot of volatility in the long end of the Treasury curve. So people are paying attention to the 10-year and to the 20-year, and there's been incredible volatility in that space in just the last month. I mean, even the 20-year has had a total return change of over 7.5% in 1 month alone. So that worries investors, and it concerns people that there's a lot of volatility in the market reflected of this uncertainty. Where you don't see as much volatility and you do see stability, and I think continues to be a safe haven for investors, is in the shorter end of the curve where rates have been more stable.
All right. Carsten, coming over to you. One of the things that's really been hitting the market is people just really confused about the tariff policy, the trade policy, wondering about what happens next. Today, these 245% tariffs that are Megan Casella, she's coming up later in the show, she clarifies it's on a small number of goods that already had 100% tariffs before, things like EVs. But just the fact that it seems like a lot of investors and even some of us, we're always trying to figure out what's going on. What do you think that does to market sentiment?
Well, uncertainty, Frank, obviously, because would you really be able currently to mention all the tariffs that are really been put in place? I hardly can. So this really means the market is looking for guidance that they will not get anytime soon, because this trade war escalation is going to continue. This back and forth is going to continue because, at best, we're currently entering now a phase of potential negotiations between the U.S. and the EU, between the U.S. and China. But, these things will not be solved in a short time. So this is really looking for guidance for a long while.
Yeah. Carsten, I want to go to one other thing. You actually put out some guidance, or a forecast, I should say, on how you see the U.S. economy shaping up and also inflation here in the U.S. So you see GDP this year coming in at 1.4%. You see inflation topping 4%. What does that do to the equity market?
Well, this is not being good for the equity market, because what we do see is clearly in a textbook how a trade war plays out. It first pushes up prices in the U.S., so that is the inflationary part. Once we have inflation, the customers will start to suffer, retail will start to suffer, and then you're going to get this contraction of the U.S. economy. Well, I think is then waiting for the Fed to step in, but I cannot see the Fed already cutting interest rates right now, especially not if they are really looking into a inflationary shock. So at best, what I can see is the Fed starting to cut interest rates after the summer.
Joanna, coming back over to you. Bonds, they've generally been a safe haven for investors in times of volatility, but we've seen so much movement in the bond market. In fact, I was talking to a trader about the retail sales number coming up, just positioning ahead of that. We're going to talk about that later in the show. And he told me, previously the 10-year, that's where you would hide out. But right now, a lot of people are worried about just the moves, the bond vigilantes, possibly responding to moves like this, the announcement of 245% tariffs on some things that's just going to raise a lot of the uncertainty that people have about the markets. Where is there a good place in the bond market, whether it be corporates or treasuries? Where in your mind is there a safe place?
Okay, the safe thing in your portfolio right now is to add income to your portfolio, and that's what bonds do. Income offsets volatility. So there's lots of opportunities across the bond market where you can access this income. And when we think about relative volatility, we're thinking about a deceleration in the economic fundamentals or in growth, and people are worried about the equity market, prices going down. This is the time where bonds are going to play a critical role in your portfolio. It's a critical time to add bonds to your portfolio because the income they offer.
Which ones?
Well, it depends on your approach. So if you are going to cash because you want to move out of the S&P 500, you should be looking at the Treasury market. We recommend, the 1 year, 2 year, and 6 month space. If we also like corporate credit, because although we will see pressure on companies going forward and there is some uncertainty, we don't see the fundamentals breaking down where a corporation won't be able to pay its debt. That is a very severe situation that could be offset any day now or within the next quarter, depending on all these negotiations. So even corporate debt is a great place. You're talking about half the volatility of the S&P 500 and maybe 2 or 3 times the amount of income. That income is the tool that we haven't gotten investors to really utilize to remind them of diversification, because they're really focused on this equity, downturn that's just painful to watch in your portfolio. You need those bonds.
But to be clear, you're talking about investment grade. I know you've come on a lot of time to talk about high yield, but is this the right environment for high yield? It feels like the safe place, if you're talking corporates, would be investment grade.
Yeah, so absolutely, investment grade is a great place to add this income. It's generally paying over 5% right now. It has, like I said, a lot less volatility than the S&P 500. But when you look at high yield and how it's performed versus the S&P 500, what people don't realize is that high yield has a similar volatility to the S&P 500, but it has performed dramatically differently.
Okay.
And it's held up in this market. So that income of over 13% in high yield on the triple C side, or 7% on the broad space, has really insulated all of this downturn on the equity markets.
All right. Carsten, coming over to you, I'm going to give you the last word. A lot of people are looking for a place for safety, a safe haven in the equity market. We know people have turned to bonds. They've also turned to gold quite a bit. But is there any place to go in the equity market where you're not going to see so much volatility from trade policy and from tariff policy, and maybe you can have a relative gain compared to the rest of the market?
I think currently it's really hard to see this safe place unless it's under your own mattress in your bedroom at home. Really, this is going to last, the uncertainty, and I think take a step back. And the end game always used to be, or was meant to be, that foreign companies would come to the U.S. to really invest and increase production in the U.S. Well, I think and you could see some sense in the story with deregulation, lower taxes, and using tariffs to push them over. But I think what happened now over the last 2 weeks, there's these erratic policy announcements in foreign companies now having clearly some concerns about the rule of law in the U.S. I wonder whether we really will see lots of foreign investments coming to the U.S.